Welcome to the Capital News. I am your host, Alex Kreitis. Today is September 4th, 2019. Thank you so much for joining me. Hope all of you enjoyed your Labor Day weekend here in the States. I know I didn't give a podcast yesterday. I threw out my back like an idiot. I'm feeling a little bit better today, which is why I'm doing the podcast, and I really just don't want to go too many days without doing one because there's been a lot that has been taking place in every corner of the world. All of the stories that we talk about here on a daily basis, where we try to talk about them one day at a time, separately, individually, are all coming together. So we got to talk about Brexit today. We got to talk about Hong Kong. We got to talk about the U.S.-China trade talks, and a whole host of other things. But those are going to be the finer talking points for today's podcast. Yesterday in the markets, we saw a sell-off of 1%. Well, today, we got a lot of that back because the markets rallied 1%. We have the S&P up 31.5 points, a gain of 1%. The Dow Jones Industrial Average gained 240 points, 0.9% gain. The NASDAQ gained 103 points, an increase of 1.3%. And the Russell 2000, the small cap index, gained 12.5 points, or an increase of 0.8%. The Dow Jones Transport also gained 1.2%, and the New York Stock Exchange was up 1% as well. Now, this is very fitting with our volatility model that we've been talking about here for months. On an updated basis, this is still par for the course, ladies and gentlemen, for the rest of this year and quite possibly well into next year as well. We are going to continue to see volatility, and as we define it, that is a daily move of 1% plus or minus. So yesterday would have been counted as a volatility day. Today is a volatility day. These are going to continue. From what we are noticing with our volatility model, again, it's par for the course. Our analysis has not deviated. We are going to continue to see, most likely, the Russell 2000 and the NASDAQ continue with its current volatility that we have already witnessed thus far throughout this year. It is simply going to continue, okay? So we might have 1 or 2 days a week of plus or minus 1% gains or losses for those two respective indices. Conversely, for the S&P 500 and for the Dow Jones Industrial Average, in order for our volatility model to hold water throughout the remainder of this year, we are going to see plus or minus 1% moves, probably at least 2 to 3 per week for the rest of this year. Now, that could be choppy waters, which is what we saw through August. We saw a consolidation, up 1%, down 1%, down another percent, up, down, down, up and up. It was very choppy waters. If you were to graph this out, you would see a very tight range for the S&P 500, for the NASDAQ, for the Dow Jones Industrial Average. Typically, markets don't hold these types of ranges for very long. They have held for a month now and have sort of continued through today. We will see what happens tomorrow in some of the headline news that was breaking today, which led to the 1% gain, and then some other news that is just breaking here recently as I'm doing this podcast, is probably going to continue with another short-lived rally tomorrow. Now, we'll see if this thing has legs and if this is the beginning of a trend. We will see. One day does not make a trend, but we're going to discuss that. We're going to analyze those points. But for the volatility model, buckle up. Typically speaking, historically speaking, when you see this type of volatility, investors don't like this type of volatility, so it tends to coincide with big and major sell-offs in the equity market space. That's not a rule. That's not a law. That does not have to happen. Just simply what history tells us and what I'm basing my analysis off of is that is what we are more likely to see. Now, given these trade headlines, given some of the headlines out of Hong Kong, people might be clinging to hope. They might think this is something to rally on, and this thing could gather some steam, it could grab some legs, and we could witness some sort of a melt up that we've been talking about. So it's still heads or tails. It's anybody's guess. I don't like talking like this because I'd rather place most of my emphasis analysis off of the data. That being said, I continue to have a bearish tint, a bearish slant to these markets just because of the fundamentals. The headlines are only going to last so long. But we live in a world where we have computers doing a lot of the daily trading, and they scour the internet. They scour, like I said, newspapers and the internet for headlines. And if it's something that's positive, here's what it does. does not care about you, does not care about your 401k, doesn't care about the long term. It's chop, let's scalp some profits here, let's scalp some profits there, in and out, in and out, in and out. So this is just something to be mindful of. But again, the volatility model holds water as far as I'm concerned, and we will continue to monitor the situation. Oil has also been wishy-washy, back and forth, back and forth. We're going into a global recession. Up, nope, everything's okay. Up, nope, we're going back down. Up, nope, everything's okay. So you can't make heads or tails out of the oil market either. But we have WTI trading at $56.56 a barrel. Brent, the international metric, is trading at nearly $61 a barrel. And it was only a couple of days ago where we had both of these well lower than where they are today. Gold and silver are still catching quite the bid. Gold is trading at $1,541 an ounce. Silver is above $19 and is trading at $19.40 an ounce. We're going to talk about that shortly here too, in the backdrop of everything else that's going on. We have Uncle Sam's 10-year Treasury note now yielding 1.52%. It was below 1.5% earlier. It is now back above. This is sort of the risk-on event, so people are getting out of the safe haven asset of U.S. Treasuries, getting into the stock market. We'll see how long this lives. We have the VIX, the volatility index, down nearly 12% on the day and is now trading at $17.33. If this continues to go much lower, the volatility index, I'm going to say look out below, because we haven't seen a sustained period where the VIX has been below 17 for quite a while. So we're going to keep our eye on this, because this could be some sort of a bull trap in the market. That is to say, this is sort of this rally, which could be short-lived, could prove to be short-lived, and that would be deemed a bull trap rally, which means it got a lot of people off the sidelines into the market thinking everything was going to be fine and dandy, and then boom, before you know it, there's another headline. Markets start to look at the fundamentals, and they say, nope, not so fast, we're going back down. So it's something to be mindful of, especially given the technical levels of this consolidation that we're in, where we're starting to perhaps break out of it. So we're going to have to monitor this closely to see what transpires. Now, on the geopolitical front and on some of the headline news front, we have, I don't know if this is the final act of this Shakespearean drama or tragedy or comedy, whatever you want to say. But it's Shakespearean nonetheless, and you couldn't expect anything but this from the British people. And of course, we're talking about Brexit, because we do have the new Prime Minister, Boris Johnson, at the helm. He is trying to play hardball with everybody right now in British politics. Well, Parliament has seemingly delayed Brexit. This is not hard and fast by any stretch of the imagination. The Prime Minister, Boris Johnson, is still saying, he is still claiming that one way or the other, the British people will be leaving the European Union on October 31st, Halloween Day, come hell or high water, with a deal or with no deal. Doesn't matter. Time's up. You've had 3 years to debate this. You've had 3 years to come up with a deal. You don't want to vote for it. You do want to vote for it. You don't want to vote for it. Time's up. You've had 3 years. And now they want to pin all of this, of course, on Prime Minister Boris Johnson, because he's the new guy in town. He's playing hardball. He's saying, look, the British people voted 3 years ago. 3 years ago, ladies and gentlemen, there's still no conclusion. There was supposed to be a conclusion back in March of this year, at the end of March. That deadline, which was supposed to be a hard deadline, got shot down. And now we have Halloween. So we'll see what kind of trick-or-treat is going to be played here, but you can bet your rear end that there's a whole bunch of politics being played. You continue to have Parliament divided. However, what we're currently seeing here is Parliament is now saying, look, we can't leave without a deal. There has to be a deal. There just has to be a deal. We can't crash out, because it's just going to be too devastating for the economy. The British people aren't going to be able to live. Food prices are going to skyrocket. Medications are going to skyrocket. People are going to have to leave the country who are here on work permissions, and actually those don't even exist. You're just here. If you're part of the EU, you can come in, you can work, do this, that, and the other. Basically, borderless travel. You know, there's a whole bunch of unknowns that are at play here because there is not a deal. Well, shame on them. They've had 3 years. How much longer are they going to continue with this? Now, you also had the Prime Minister attempt to call for a snap election, a general election over in the UK to take place on October 15th, which would only be 2 weeks prior to the Halloween deadline of Brexit. That got shut down. Now, I imagine that the Prime Minister will try again, or he will pull some other antics. This is a big cluster, you-know-what, over there, folks. There's no other way to explain it. Again, I don't know if this is a Shakespearean tragedy or comedy, but, I mean, enough's enough. The British people voted 3 years ago. This is the consequence of that. You got to leave. It wasn't some sort of, it wasn't some dog and pony show. It was a vote. They wanted to leave. You had 3 years to negotiate. You don't have anything done. Now it's just time to walk out. You tried to have a civil divorce. You couldn't do it. Now it's just time to leave the house. Take what you want and leave. Go. Call it a quits. You'll work it out. You'll be fine. I'm telling you, you'll be fine. Is there going to be some short-term pain? Yeah, there will be. I never said this was going to be easy peasy. But, just look at the context of the British people. They got through World War I. They got through World War II. They got through the Great Depression. They got through a whole bunch of things. They will get through this, okay? We will get through this. It will be okay. The further they delay this, the worse it's going to be, because there are still calls for a second referendum. If that happens, there is going to be, I would imagine, some sort of revolt, some sort of mini revolution over there. Most definitely political riots that we haven't seen to that extent potentially in the UK if there is another referendum. You have the likes of Nigel Farage, who has been a huge proponent of Brexit, who is a member of European Parliament, who got back into the fold after Theresa May, the former Prime Minister of the UK, was unable to strike a deal and kick the can down the road to where we currently sit. So Nigel Farage got back into the game, created the Brexit Party, sent many people from the UK to the European Parliament, trying to cause as much ruckus as possible. Because, look, if you're not going to let us leave, or something's going to happen, we're going to make it a living hell for EU bureaucrats. That's fine with me. I'm for Brexit. I think it's the best thing for the British people. I personally do. Could there be things that they could agree on with the EU to maintain some of the things they like? Sure. But, the EU, they're going to play hardball, and that's what they're saying. So they told the British people, they told Parliament, they said, look, we worked with Theresa May for a long time to come up with a deal. This is it. Parliament shot it down 3 separate times. This is it. There's no more discussion. There's no more negotiation. As it stands right now, the EU is sticking to that, at least publicly. Whether things are taking place behind the scenes, I couldn't speak to that. But at least publicly, they're continuing to say there's not going to be any new deal. We have it. You're going to have to take it back and vote for it, or that's it. So that's where that stands. This is going to continue. This is going to come down to the wire. Remember, it was just last week we were saying that Boris Johnson wanted to suspend Parliament and call for the prorogation. That's basically where the Queen is going to give a speech. So this is going to look very Shakespearean here in the next couple of weeks when she gives her speech and is dressed to the nines. Now, we have news over on the Asia front with Hong Kong. It appears that the chief executive of Hong Kong, Carrie Lam, is going to formally remove the extradition bill that has been causing a lot of this ruckus, a lot of the protests that we have been witnessing over there on Hong Kong for the past 13 weeks. So a few months here already. However, while this is definitely something in the positive light, this isn't everything that the protesters have been protesting about. There's a handful of other bullet points that they want to see. You have some of the, I don't want to say formal leadership of this movement, because there isn't really any really formal leadership here with these protesters, but there are some well-known protesters out there who are saying, look, this isn't enough. Basically, it's a step in the right direction, but the protests are going to continue. Whether that is the case remains to be seen, but we're going to keep you posted on that. Now, it's interesting because this extradition bill was basically set up that was going to allow China to extradite Hong Kongers, anybody in Hong Kong, to the mainland to be tried in a Chinese court. And of course, the Hong Kongers did not like this. They do not like this, and that's why we have seen these protests taking place for 13 consecutive weeks, and I imagine they will continue. But this might be the step in the right direction. We never wanted to see this turn into violence. The Chinese were putting their troops down close to the Hong Kong border. If they had crossed into Hong Kong to sort of quash this rebellion, this protest, that would have been bad news bears, no doubt about it. We would have seen huge market sell-offs all over the world. U.S.-China trade talks would have been off the table. Just would have been bad for everybody. But it seems, at least for now, that is off the table. We don't have to concern ourselves with that unless these protests, for whatever reason, really reignite for some other issue and cause some bigger problems. Then we'll have to see if Beijing takes action to come in to quash that rebellion or those protests as they would see them. So, is that good news for the U.S.-China trade talks? Is this sort of a signal from Beijing that, yeah, we don't have to play the strongman. We don't have to come down with an iron fist. If Carrie Lam, the chief executive of Hong Kong, wants to formally remove this bill, this extradition bill, maybe we'll let her do it. That would be a gesture, I think, that they are willing to come back to the negotiating table and perhaps make a deal. We'll see. I'm skeptical of that, but at least it is a show of peace as opposed to a show of strength in the iron fist and perhaps some little physical violent breakout, which nobody wants to see. So that takes us to the U.S.-China trade talks. We now have confirming news that there will be formal high-level trade talks between the United States and China taking place in Washington, D.C. Within the coming weeks. That's most likely going to be in October. There are supposed to be lower-level discussions taking place throughout September, so I guess to lay the groundwork for the big dogs when they get together in Washington, D.C. in October. Now, this is interesting because I don't know how this is going to play out. Because we've been told by the U.S. administration that we're in the final laps, that there's going to be a signing ceremony, that everything is fine, that there's going to be a deal, and the U.S. is going to win bigly, and everything is just going to be fine. Well, of course, that's not the case. That's not true. That was not true. That was seemingly never true because it never happened. Then we had the escalation. Then we had the trade truce, which was very short-lived, not even really a full month. And then there was further escalation on both sides. And now here we are, presently, and the talks are scheduled to continue in October. Could this be, and like I've said for quite a while here, could this be rope-a-dope? Could this be the Chinese implementing Muhammad Ali's rope-a-dope strategy, with, of course, the United States being the dope in this case? And I hope that's not the case, but it could be, because China doesn't have to make a deal. The U.S. doesn't have to make a deal. Personally, I don't know what a deal is going to look like. I don't know who is going to trust the deal. Because we've been told by this administration, the Trump administration, that we cannot trust the Chinese. That for 20, 30 years they've been ripping us off, taking us to the wood chipper. They can't be trusted. We were told in the most recent truce just a couple months ago that they were supposed to buy more U.S. agricultural products. Did not happen. So, who do we believe? How can you take them at their word if they sign something? Furthermore, at this juncture, how can you even trust Donald Trump with all of the things that he has said that have not come true? So there's going to be such a huge lack of credibility from both sides here. If they sign something, it's going to be completely ceremonial, in my opinion. Now, I could be wrong. Maybe they will come to some grand agreement, and everything's going to be just fine. And this will somehow miraculously pull the markets out of any type of concept of recession. I don't think that's going to happen, but who knows? Maybe it will. Furthermore, if this is rope-a-dope, China could they could really string this out for the next several months, and then boom, say, no, we're not going to make a deal. Well, what's going to happen when they come out and say we're not going to make a deal? Several months along, where we're well into the 2020 presidential election. Do I have to spell it out for you? The market's going to sell off like crazy. And now what are you going to have Donald Trump saying? I mean, now there's risk in this, don't get me wrong. The Chinese would have to risk people, solidifying, getting around Donald Trump, saying, look, they conned him, they strung him along. But then that's just going to say to a lot of people, anti-Trumpers, a lot of Democrats, maybe even a lot of independents, look, this guy, art of the deal, he doesn't know what the hell he's doing. He couldn't get a deal. He said these things were going to be easy. In the meantime, there's tariffs all over the place. Prices are going up. People are losing their jobs. We thought he was going to get something, and then boom. So pros and cons to everything. It's possible that this is rope-a-dope. It's also possible that there could be a genuine deal. I have more weight and more probability to the former, that this is rope-a-dope, because I don't see why the Chinese would make a deal unless they are really, really hurting and they think this is the best way to do it. And they will just sort of brush this to the side. They will just put Donald Trump to the side for a few months. We'll continue these talks maybe through the rest of the year. We'll have a signing ceremony. We're not going to hold up our end of the bargain, but maybe we'll do a slow drip. Slow drip, make it seem like we're doing something. And we'll go from there. I mean, it's pure speculation at this point from everybody involved. Everybody involved. Because you don't know who to trust. You cannot trust Donald Trump because nothing he said has come true. Not a thing. Everything's fine, then there's escalation. Everything's fine, then there's escalation. And then, he wants to bully them, bring them to the negotiating table. They have to make a deal. Their economy is the worst it's been in 27-something years. The tariffs are killing them. They're crushing them. They have to make a deal. They have to come back to me. And I'm sure Donald Trump is aware of this, or at least I hope somebody in his administration is, of the possibility that China could play rope-a-dope. And they could string them along, and then boom, no deal. Meanwhile, you're only a couple months away from Election Day in 2020. I know it seems like it's an eternity away, but it'll be here very quickly. No doubt about it. So we got the Brexit chaos, the Shakespearean drama or tragedy. You can cry, laugh, whatever you want to do. I don't care. You got the Hong Kong story that continues. Maybe that's a good gesture from the Chinese that everything's okay. We're going to calm this down. Maybe we can come to an agreement. Or maybe it's rope-a-dope. But nevertheless, the markets like it right now. We have the Japanese markets, I believe, up 2.5%. Yes, up 2.5%, 514 points. Currently, as I do this podcast, we have the Chinese markets up 1.7%. We have the South Korean market, which I say is, could be looked as a forward-looking indicator, is up 1% and back above 2,000 points. It wasn't that long ago where we were flirting with 1,900. We are now at 2,000 once again. Again, is this going to be short-lived, or is this something more to come? We have the Hong Kong markets, which rallied bigly, if you will, yesterday. And now they are currently trading up another 0.5 percentage point. But I believe they gained about 1,000 points earlier today. So that's quite interesting. But, of course, that's on the back of that positive headline news from Hong Kong. We also have the New Zealand market, I believe, hitting an all-time high, trading at 11,109 points. And we also have the Australian markets up, I believe, at a several-week high. And that is coinciding right now with the Australian dollar, which I believe is at a 5-week high, which is typically not the case. You usually see it the other way around. You usually see a weaker currency and a stronger stock market, which is what we had been witnessing with the FTSE market, which is, of course, the British markets, because with all of the headline news coming out of Brexit, you had the British pound selling off quite aggressively, and conversely, you had the FTSE, the British markets, rallying. Now you have the pound recovering some of that, but you still have the stock market increasing. So that is going to leave us with what I want to follow up with and sort of close this podcast with, and that is the divergence that we are starting to see between different asset classes. And where's reality going to settle? Because we have a huge flight to safety in bonds, which is why we see interest rates so low, because the price of a bond and its yield are inversely related. So if the price is going up because it's catching a bid, because a lot of people are buying bonds for safety, then the yield, that is going to suppress the yield. Higher price, lower yield. Okay? We are seeing the 30-year Treasury bond below 2% at its lowest in history. What that tells us on the surface is the markets are pretty much anticipating very little growth for the next 20 to 30 years. Very little growth for the next 20 to 30 years. Because if you're going to park your money in a U.S. Treasury bond and you're only going to get 2%, less than 2% for the next 30 years, I mean, on a relative basis, what do you think you're beating, right? I mean, that's what you're looking at. So that's not painting a pretty picture. You see this across the yield curve. This is why you've had recently the yield curve inversion between the 10-year and the 2-year, but you've also seen yield curve inversion on the 10-year Treasury note and the 3-month Treasury bill. And we have done much discussion on those. We're going to be posting some videos on that on thecapitalnews.com and on our YouTube channel, The Capital News. Check that out. We did post another video over the weekend focusing on the federal funds rate. So I ask that you do check that out. But we have a divergence here. We have a flight to safety in bonds. We seemingly have a flight to safety with precious metals, gold, silver, platinum, which I believe is in the beginning stages of a bull run here, a multi-year bull run. We have the internals of the stock market. We have the Russell 2000 continuing to roll over, continuing to go to the downside from a longer term perspective. We have the U.S. mid-caps, same thing, rolling over. We have the Dow Jones transports, again, rolling over to the downside. What continues to level off or gain higher, go higher, is the NASDAQ, is the S&P 500, and is the Dow Jones Industrial Average. These are the biggest of the biggest indices out there. How much longer can this divergence continue? Typically speaking, we've stated this here many a times, and you'll hear this in the mainstream media, in the financial mainstream media all the time too, because it is true that the bond market is typically the better forecaster of what's to come. Not the stock market, but the bond market. Well, the bond market has been telling us for quite a while that there's going to be slower growth. However, stocks continue to flirt with their all-time highs. And again, that's on the major indices. On the mid-caps, on the small caps, on the micro-caps, not even close. When you look at copper, making 2-year lows, okay? 2-year lows. So something's amiss here. Now, we've been talking also in previous podcasts that I anticipated there's going to be some big decoupling throughout these markets. Maybe that's what we're witnessing. But I don't know how much longer this can continue. Something's got to give, folks. The bond market's either got to be wrong, and there's going to be a huge sell-off in bonds, which means there's going to be a huge spike in interest rates, which isn't going to be good for anybody. Although that would be the market's correction, and that would actually be the best thing for us, although Donald Trump will go ballistic, and a whole host of other people will go ballistic as well. But that would be the market's correction, that interest rates got to come up, all of this malinvestment's got to come home to roost. That ain't going to be pretty, but neither is what's going to come anyway. I mean, it's coming, folks. It doesn't matter if the market brings it, if the Federal Reserve pricks the bubble, it's coming. Believe me when I tell you. It's just a matter of what the catalyst is going to be. And subsequent podcasts, what we're going to do here and what we do here on a daily basis is talk about those catalysts. So it could come out of anywhere. So here's what you have to ask yourself with these current divergences right now, okay? You have to say, all right, in one group, in one corner, we have the S&P 500, we have the NASDAQ, and we have the Dow, all right? In the other corner, we have gold, silver, platinum, okay, the precious metals. We have the commodities. We have oil. We have copper, all right? We have the internals of the stock market. We have the U.S. mid-caps. We have the small caps. We got the micro caps, okay? And we have the bond market. All of those items in that corner say that there is slower growth ahead and quite possibly a recession. The other corner with those other 8 indices are saying, nope, everything's fine, and we might actually rally here. There might actually be a melt-up. Everything is just going to be A-okay. Now, if that happens, if there is a melt-up, look, you got to play the game of probabilities. I'm not going to say this is the first time in history that's going to happen because there was a period back in 1995. You had the continuation of the dot-com bubble. You had the continuation in 1998, 1999. That could happen here. But then what happened subsequently? A drop of 80%. Now, you want the high. Do you want the hangover? Because that ain't going to be pretty, folks. I'm already calling for a 40% decline base case, and I know it's going to be worse than that, but base case it's going to be 40%. If you get this type of melt up, that's it. I mean, 40% is going to be, I mean, you could witness that in a couple months, if not sooner. So if you want the high, that's fantastic, but get ready for the hangover. So in a game of probability, you have the internals of the stock market, you got the bond market, you got the precious metals market, and you have commodities, all pointing to lower growth for a longer period of time. In the other corner, you got the Three Stooges. Now, maybe the Three Stooges get lucky, but is that where you want to park your money? Is that where you want to put your money? Now, look, I am not a perma bear, but right now I'm just trying to be realistic with the fundamental data that we have before us. These markets are trading on the headlines. If they were forced to look at the underlying fundamental economic and financial market data out there, they would be selling lower. And that's typically what happens. When there isn't any type of headline news driving the market higher, the markets are forced to look at the real news. And when they look at the real news, they sell off. But we're one tweet away from all-time highs. You never know. I mean, that drives me crazy like you can't believe. It's market manipulation. He should be investigated for this, but nobody's going to do a damn thing. But those are the questions that you have to ask yourself. What are the probabilities? Who's going to be right? The bond market, the precious metals market, the internals of the stock market, the commodities market, or is the S&P 500, the Dow Jones, and the NASDAQ going to continue to go higher and higher? We shall see. That's why we do this on a daily basis. It makes it exciting. But stay diversified, stay vigilant, and stay with the Capital News. I am Alex Karitis. Godspeed.